Good morning, and welcome to today's webcast, Prepare Your ESG Reporting for 2026 Regulatory Changes. Before we begin, I'm going to play a brief housekeeping video.
Welcome and thanks for joining us. Our webcasts are designed to help elevate your business performance. Transform your future for the better with advisory solutions tailored to your vision and supported by our collective technical resources. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget. You can ask our presenter questions during the webcast by typing a question in the Q&A window and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% or 3 of the 4 polling questions, which we'll ask throughout today's presentation. Polling questions will appear within the slide window. To participate in the polls, please click on your answer and be sure to hit the Submit button to record your response. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry, if you can't download your CPE certificate today, we'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our group CPE attendance sheet to receive credit. The attendance sheet is available in our slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit only can be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
Before we get started, I wanted to share our big news, that Moss Adams and Baker Tilly have joined forces to redefine accounting, tax, and advisory services for the middle market. It's really exciting, and you can read more about it on our website via the link in the slide deck and handouts widget. With that, I will turn it over to Anna to get us started.
All right. Good morning, everyone, or good afternoon, depending on where you're joining us from. We wanted to say thank you for attending our webcast today. As Maddie and I reflected on 2025, it certainly felt like a year full of regulatory updates, lots of changes. Companies have been asked to kind of keep track of a lot of changes, both on a global and just in the United States basis. So, I'm an auditor in public accounting. Regulations are generally kind of my jam, but even I'm feeling a little fatigued and tired from keeping up with all these updates. So we do appreciate you joining us today to continue to hear a little bit about what's changing and also to pause and think a little bit about what we're expecting to see in the future. By way of introduction, my name is Anna Waldren. I'm a senior manager at Baker Tilly. I've been with the firm for 11 years, and I split my time between sort of our standard financial statement audit work, as well as helping to lead our ESG assurance practice. Been working in ESG assurance for about 10 years, and it's certainly been an interesting, changing, dynamic field to work in, but I'll pass it over to Maddie.
Yeah, thanks, Anna. So hi, everyone. My name is Madison Poitras. I'm an ESG senior manager, part of Baker Tilly's consulting group within our strategy and operations practice. I've been in the climate sustainability internal audit space for over 10 years now. My background really has been focused in ESG within a variety of industries related to ESG regulatory compliance, reporting with ESG frameworks, and internal controls over ESG data. So with that, here is our very exciting agenda for today. So we're going to start with a broad overview of the California climate bills. We're then going to talk through recent updates. As Anna alluded to, there have been many of them over the past couple of weeks, and I'm sure many folks are interested to hear the latest and greatest. And then we're going to talk through how to prepare for compliance. And then we'll also lightly touch on other key state regulations and trends to be aware of. So with that, we're going to pivot to our learning objectives. So during today's webinar, we are aiming for you to take away the following key points aligned with our agenda. Gain a clear understanding of the scope, applicability, and current status of California's corporate climate disclosure laws. Familiarize yourself with the timeliness and reporting requirements for SB 253, SB 261, as well as the supporting bill of SB 219. Learn the essential or necessary steps to prepare for the upcoming regulations, and then identifying other states, that are currently developing similar climate reporting requirements. So we'll cover as much as possible during today's session and address questions in the chat as they come up as best we can. However, if we don't get to your questions, we'll be sure to follow up via email. But before the exciting content, we're going to start with a polling question. So polling question number 1, what brings you to today's session? A, I'm trying to determine if my company is subject to the upcoming California climate reporting requirements. B, I'm in process on preparing for SB 253 or SB 261 and looking to hear recent updates. Or C, I'm not subject to either California's climate Senate bills, but I'm looking to learn more about greenhouse gas emissions and sustainability reporting. All right, so let's get that CPE credit in there. I see quite a few folks have already responded. I'm just going to give it a little longer because I know we're in December and people want those CPE credits. We're almost there. My hunch it's going to be option B, so I'm curious to see. All right, 10 more seconds. 5, 4. All right, I'm going to call it. Thank you all. Oh, I am wrong. It is option A. So I am trying to determine if my company is subject to the upcoming California climate reporting requirements. Or C, generally just interested about, greenhouse gas emissions and sustainability reporting. All right. So with that, we're going to jump into our content for today. We're going to provide a brief overview on these two bills for all those folks that aren't familiar with them. And then, I'm sure many folks are familiar with them, but need a quick refresher on what these bills truly mean. So this slide here provides that high-level overview of SB 253 as well as SB 261 climate disclosure laws. So let's start by focusing on SB 253 highlighted in that second column there. So SB 253, also known as the Climate Corporate Data Accountability Act, requires U.S. organized entities exceeding 1 billion that do business in California to publicly disclose their annual Scope 1, Scope 2, and Scope 3 greenhouse gas emissions. So reporting under SB 253, it is recommended to align with the Greenhouse Gas Protocol, which is known as kind of the gold standard of carbon accounting. The first disclosures are due in 2026. Initially, limited assurance is required for Scope 1 and Scope 2 emissions, with assurance expectations increasing in subsequent years. There's a little asterisk next to that Anna will get into in a couple of slides, but for an overview, that is the basis. Now turning to that third column, SB 261, which is also known as the Climate-Related Financial Risk Act. This mandates biennial disclosure of climate-related financial risks following the TCFD framework. For those that aren't familiar, TCFD stands for Task Force on Climate-Related Financial Disclosures, or an equivalent standard. But I will say for most folks, that haven't done this type of climate reporting for SB 261, most folks are leaning heavily on that TCFD framework. So this law applies to entities with revenue over 500 million, so a little bit lower compared to SB 253, which was 1 billion. And the first disclosures were originally scheduled for January 1 of 2026. However, enforcement has been temporarily paused due to a preliminary injunction issued by the Ninth Circuit Court of Appeals. So Anna will go into a little bit more detail in just a handful of slides related to that update as well. So in addition to having these climate-related financial risk reports up on your website, you're also required to submit a URL link to where the report is located on your website to a public docket. So this docket was actually opened by CARB on Monday and is intended to stay open until July 1st of 2026. At this time, the public docket states that this is a voluntary submission, underscoring, that injunction of the Ninth Circuit Court to Appeals. So more to come there, but wanted to let people know that docket is up and running. All right, so for the next couple of slides here, we're going to talk through some key definitions that Anna and I get asked about pretty frequently. So please note that this information is based on CARB's most recent guidance from their November 18th workshop, but we're obviously still awaiting the final rules, which CARB expects to publish in the first quarter of next year. So this is recent guidance, but obviously we still want those updated rules to come out and clarify some of these gray areas that we're seeing. So with that, let's talk about how CARB is defining revenues for these bills. So currently, CARB defines revenue based on gross receipts concept outlined in the California Revenue and Taxation Code section, which is cited on this slide here. So this includes the total amount realized from sales, exchanges of property, provision of services, or use of property or capital, such as rents, royalties, interest, and dividends in transactions that generate business income. So an important note, these amounts are not reduced by the cost of goods sold or the basis of the property sold. The income gain or loss is recognized or would be recognized under the Internal Revenue Code as applicable. So to address fluctuations in revenue that may affect reporting obligation, CARB determines applicability by looking at the lesser revenue figure from the entity's two most recent fiscal years. So for example, if your revenue falls below the SB 253 or SB 261 threshold in either year, the entity is not required to report for that cycle. This was communicated in their last workshop that took place on November 18th. So if you would like more information on this, you can refer to CARB's frequently asked questions or FAQs, which were actually updated as of November 17th. Specifically refer to FAQ 8 and FAQ 15, which does clarify that revenue calculations, consider that total gross receipts regardless of whether that income was generated within California. Additionally, the FAQ addresses that the revenue threshold is assessed at the individual company level. However, if a parent company and its subsidiaries file taxes at a unitary business in California, the subsidiaries' revenues are aggregated within the parent's gross receipts to determine applicability. So long answer short, entities should refer to the FAQs by CARB, and they should refer to the corporate tax filings to verify their gross receipts. And with that, we're going to jump into our next key definition that we get asked about quite frequently. So this slide here includes CARB's definition of what doing business in California means based on past workshops. So within that light blue box at the bottom of the slide, you'll note that CARB is proposing the revised definition of doing business in California in response, I would say, to numerous, public comments indicating that sections of the previous guidance criteria relating to property holdings as well as payroll thresholds, were too low. So with this recent guidance, CARB is noting an entity is doing business in California for purposes of the reporting regulation if the entity is actively engaging in any transaction for the purpose of financial gain or profit, and any of the following conditions are met during any part of the taxable year, including the entity is organized or commercially located in the state, or if the entity has sales in California, including those by agents or independent contractors, exceeding that 2024 adjusted threshold of around 700K. So this definition was originally proposed during the May workshop and then further discussed at the August workshop. That property and payroll related criteria from California's Revenue and Tax Code, sections 23101B3 and B4 are not included in this definition. So you can see that noted in that light blue box at the bottom. So based on that stakeholder feedback, staff is proposing to omit this criteria because, as I mentioned, these bills of property or payroll presence alone may not demonstrate a sufficient economic connection to the state to constitute doing business, and therefore were considered too low of a criteria. So with that, I will pass it over to Anna to talk through some more key definitions.
All right, thank you, Maddie. Okay, so during CARB's most recent workshop, they did also speak more broadly about applicability and some of the efforts they're moving through in order to determine which entities are in or out of scope for reporting. As you may be aware, CARB did publish sort of a preliminary listing of in-scope entities, and during their most recent workshop, they did call attention to the fact that there's a number of discrepancies and issues with that preliminary report. There were duplicate entries, entities that should be in scope were left off, entities that maybe would not be in scope were included on. So CARB acknowledged that they need to continue to refine the process for identifying applicable in-scope entities. They've identified that tax filing data that comes from the Franchise Tax Board would be the most up-to-date and verifiable data for them to use for identifying those organizations. There are challenges with entities sharing information across different entities. So CARB being able to attain information from the FTB. It sounds like that's currently being worked through. And so I think we'll hear more in 2026 about what sort of resolution they were able to reach there in terms of gaining access to FTB tax filing information. But in the meantime, guidance from CARB was that they do view that entities that are currently filing with the FTB would automatically meet the revenue and doing business definitions that are being proposed by CARB staff. They included this table in their workshop slides, essentially showing, for the different types of entities, the tax forms that would be filed and where you could look on those forms to see the gross receipts and the California sales that they would use for determining whether you are in scope for these two reporting regulations. So that was a bit of a broad overview of a little bit of the applicability, and then wanted to touch on just the core elements of each of these two regulations. So starting with 253, the heart of Senate Bill 253 is really getting at companies publicly disclosing their greenhouse gas emissions in accordance with the Greenhouse Gas Protocol, which Maddie mentioned is generally considered the gold standard of greenhouse gas emissions reporting. There are three buckets of greenhouse gas emissions: Scope 1, Scope 2, and Scope 3. Scope 1 emissions are going to be an entity's direct emissions that stem from any sources that they own or directly control. Generally, we see this as things like natural gas, diesel, propane usage for heating at facilities or offices, vehicles that are owned or leased by the company, or equipment, fuel-burning equipment used by the organization. Scope 2 emissions are all indirect greenhouse gas emissions that are consumed from electricity, steam, heating, or cooling. In practice, we generally see the largest contributor of Scope 2 emissions being electricity usage at facilities that are either owned or rented by organizations. And then Scope 3 is the catch-all for all other indirect upstream or downstream greenhouse gas emissions that haven't already been captured in a company's Scope 2 emissions. There's 15 categories. These include things like purchased goods and services, emissions relating from business travel, employee commuting, the processing or use of sold products, waste generated in operations, and a number of other categories. At its heart, the calculation of greenhouse gas emissions is not complicated, although, as people are starting to get exposed to greenhouse gas footprints. It is quite daunting. Accountants and finance professionals and operations team members are being asked to kind of dabble in greenhouse gas emissions calculations. That can be daunting. You're not climate scientists. But really, at its core, the calculation is taking an organization's operations activity metrics. For example, that could be your megawatt hour usage of electricity at your facilities, multiplying that by an emission factor, and then that is how you get your total emissions. The emission factors themselves are what kind of incorporate the environmental impact of that activity metric. And there are publicly available data sets of emission factors. So generally, organizations aren't being asked to calculate the emission factors themselves or to determine what the environmental impact of their activities are. That's really incorporated in the emissions factors that are publicly available. Also, as Maddie mentioned, the California Senate Bill 253 has stated a recommended alignment with the Greenhouse Gas Protocol. There's a number of protocol guidance that's available from the World Resource Institute, or the WRI. I recommend, if you're just starting to dabble into greenhouse gas emissions calculations and reporting, a quick Google search of the Greenhouse Gas Protocol will pull up these guides. And these are intended to sort of be guides to help you walk through setting up your organizational boundaries and working through the calculation, identifying what would need to be calculated, what the methodology for calculation is. And then the WRI on its website also has a number of really helpful tools. So if you're looking for a calculator or different sorts of tools to help you start your calculation, the WRI is a great spot to start. And then also included in 253 is a requirement for starting at limited assurance over your greenhouse gas emissions reporting. The Senate bill does include an element of that eventually getting stepped up to reasonable assurance, but for the first several years, the expectation is limited assurance over your scope 1 and 2 emissions for the first year, and then your scope 1, 2, and 3 after the first reporting year. Asterisks again, which I'll cover on our CARB update slide, but written in the Senate bill is the requirement for limited assurance. For those of you that have maybe a financial statement background, we associate limited assurance very similar with a review of financial statements versus an audit, which we refer to as an examination in this space. So limited assurance is expressing a conclusion on whether the auditor is aware of any material modifications that need to be made to the greenhouse gas emissions footprint in order for it to be in accordance with the Greenhouse Gas Protocol. And then when that gets stepped up to a reasonable level of assurance, it's actually an opinion about whether the auditor is aware of any material or that the information is materially correct. In both instances, sort of the deliverable from these engagements is a 2-page auditor report, either expressing that conclusion or that opinion on the greenhouse gas emissions footprint. Okay, and we'll pause for a quick polling question here. We're curious about what the status of greenhouse gas emissions reporting is at your company. So have you never reported greenhouse gas emissions before? Have you been reporting your scope 1 and 2 emissions for at least 1 year? Have you been reporting the full footprint, scope 1, 2, and 3 for at least 1 year? And then really gold star, have you been reporting your greenhouse gas emissions and received some form of assurance? So curious where your organization is at in the greenhouse gas reporting space. I'd say, a lot of the conversations we've had with clients getting prepared for California Senate Bill 253 is that they're kind of falling in the A or B About half of the companies we talked to have never reported greenhouse gas emissions. This is really going to be the first time that they're moving through the steps of doing the calculation. And then quite a few that have actually been calculating at least scope 1 and 2 for a number of years. A lot of companies I've seen kind of started in the 2019-2020 timeline and have maybe been reporting this for a number of years, but not yet gotten to scope 3 and not yet gone through any sort of assurance over that information. So I think we're at a good level, so I'll advance us here. Perfect. Yeah, I think this aligns to what conversations we've had in the market are. Really, the Senate bills are scoping in a lot of companies that haven't previously reported this information, or companies were starting to take that first step of reporting out 1 and 2. Very few companies that have got a lot of experience reporting their full footprint and receiving assurance. So you're all in good company here.
All right.
Maddie.
Yes, thanks, Anna. So in this next section, we're going to switch gears from, SB 253 greenhouse gas emissions, and we're going to go back to the fundamentals of SB 261. So I'm seeing a lot of questions in the chat, and I know many are curious about, the current legal status, especially, regarding that injunction issued by the Ninth Circuit Court, which has essentially delayed, SB 261's enforcement action. So I promise we'll address that in more detail in just a couple of slides here. But for this section, we did just want to provide a solid understanding of the TCFD framework and the typical content for these reports, for those folks that are joining and are preparing to comply or planning to comply, just so you have a good understanding of this reporting requirement. And we will provide that legislative update shortly. So with that, let's talk about the types of climate-related financial risks, starting with the definition. So at the top of the slide here, we define what a climate-related financial risk is. And essentially, it refers to any material risk of harm to a company's financial condition or long-term performance that comes from either physical climate impacts or transition-related impacts. So we're breaking this down into two different main categories. We have our physical risks and we have our transition risks. So starting on that left-hand side for our physical risks, we think of these as direct impacts of climate change, and they fall into two different subgroups of acute risks and chronic risks. So acute risks are short-term extreme weather events like wildfires, droughts, or hurricanes. So an example of this would be Southwest U.S. drought, which impacts agriculture, water supply, and raises wildfire risk. While chronic risks are longer-term changes such as gradual temperature rise, rising sea levels, or sustained reductions in rainfall, and that can drive structural shifts in real estate, has impacts on insurance models and pricing, and long-term asset value. And then switching to the right-hand side of transition risks, I like to think of transition risks as a transition to a low-carbon economy. These have 4 different buckets, from policy, technology, market dynamics, and consumer preference. So for example, taking policy, when a government introduces a new climate regulation, such as Canada's carbon tax on CO2 emission, that would be an example of a transition risk related to policy. Another example for market dynamics. So this would include changes in customer behavior, material costs, or market demand driven by climate considerations. That would be another type of transition risk. So companies that are subject to SB 261 must assess, and disclose risks from both categories, physical and transition, when they submit their climate-related financial risk reports. And with that, we'll go into the TCFD framework. So SB 261, as I mentioned in the very beginning, relies very heavily on this TCFD framework, especially for folks, that aren't as familiar with the other frameworks like IFRS or ISSB. So this slide here does outline those 4 core elements that companies must address in those climate-related financial disclosures. The 4 core elements are interrelated and are supported by 11 recommended disclosures that build out this framework with information that is intended to help investors and other stakeholders truly understand how reporting organizations think about and assess climate-related risks and opportunities. So we will cover these 4 core elements from governance, strategy, risk management, metrics, and targets. We're going to focus on climate risk today, but I do want to note that a key element of this framework and of SB 261 is also the categorization of climate-related opportunities. So think about climate-related opportunities as well as risks when you're drafting your SB 261 report. And then one little note before I jump into the 4 core elements, I do want to note before, the latest workshop, CARB did update their minimum reporting checklist. It was updated as of 11/17. So you will want to make sure that you read that as you're preparing for SB 261. So CARB has made a lot of publicly available information to help support compliance with SB 261. And if I were getting started, the first thing I would look at is this climate-related checklist that states the minimum reporting requirements that you'll need to be aware of for your first year of reporting. All right, so starting with this first core element of governance, the TCFD framework recommends disclosures on the oversight and governance of climate-related risks at both the board and the management level, including details on how the board and management exercise their oversight and engage on the setting of climate-related targets as goals, as well as disclosure regarding climate-related expertise. So based on CARB's minimum reporting checklist that I mentioned, the minimum disclosure requirements for this governance section include describing your organization's governance structure, if any, for identifying, assessing, and managing climate-related financial risks, discuss any management oversight of climate-related risks and opportunities, including a description of board oversight if the entity has a board. So for board's oversight, topics to consider would include what are the processes and frequency in which the board or board committees are informed about climate risk, whether the board, considers climate-related issues in guiding strategy and major plans of action, and how the board monitors and oversees progress against goals and targets for addressing climate-related risks and issues. For management's oversight, topics to consider would include whether the organization has assessed climate-related responsibilities to management level positions or committees or steercos, and then how does management, monitor these climate-related issues, and how does management escalate those issues to the board? So it's important to note that many organizations, that we're talking to today that are just starting with this type of reporting, this is all very new to them, they have gaps here because they may not, currently escalate or report material climate-related risks to senior leadership. And I want to know at, CARB's latest workshop and in the minimum reporting checklist, CARB specifically notes that disclosures should reflect a company's effort to assess and communicate risk by describing the processes, governance, strategy, and risk management through which climate-related risks are identified, evaluated, and addressed. So meaning the TCFD recommendations, they acknowledge that reporting entities in the early stages of evaluating climate-related risks may begin by disclosing how these risks relate or may be relevant, even if no material risks have not yet been identified or action have taken. So as we go through the rest of these core components, keep that in mind, because essentially it means that CARB encourages reporting entities to include, description of any gaps, limitations, and assumptions made during their assessment of these climate-related issues. So in other words, it's about documenting your organization's current state, knowing that, all of these recommended disclosures may not be in place yet, especially for this first year of reporting, and that is okay based on CARB's current guidance. All right, so moving to strategy, this second core component of the TCFD framework, which includes disclosing the actual and potential impacts of climate-related risks and opportunities on the organization's business strategy and financial planning where such information is material. So based on CARB's minimum reporting checklist, a covered entity will need to describe the climate-related risks and opportunities the organization has identified over the short, medium, and long term. Include a description, what do you consider to be relevant short, medium, long-term time horizons. Include a description of specific climate-related issues potentially arising in each of those time horizons that financially impact your organization. Moving to that second sub-bullet point, you are encouraged to disclose the impact of climate-related risks and opportunity on the organization's operations, strategy, and financial planning. So essentially, organizations should describe how climate-related issues serve as an input to their financial planning, their process, those time periods used, and how these, risks and opportunities are prioritized. And then next we have that third sub-bullet point, which includes the resilience of the organization strategy. If any, you're taking into consideration the future impacts of climate change under various climate scenarios. So CARB did note on their reporting checklist the discussion regarding climate scenarios may be qualitative in nature, where a qualitative scenario-based assessment is feasible or relevant for a particular company. CARB encourages its inclusion, but it's not mandatory at this time. So many organizations, that we're working with are assessing materiality using that existing internal definition. And for this first year of reporting are adopting, a qualitative approach to scenario analysis with plans to incorporate quantitative analysis and further assessments in future reporting periods. So that scenario analysis section, that third sub-bullet point, is important to keep in mind in future reporting, because I think the stakes will go up higher and the standards will get higher based on what CARB has mentioned in the past. So moving to our third component, risk management, includes, disclosures on the description of processes for identifying, assessing, and managing climate-related risks, as well as integration into their overall risk management framework. So based on CARB's minimum reporting checklist, a covered entity will need to disclose how the reporting entity identifies, assesses, and manages climate-related risks, including a description of the reporting entity uses, the process that the reporting entity uses for identifying, managing, and assessing those risks, and how those considerations and processes are integrated into your overall risk management. So questions to ask yourself when you're drafting this section of the report: how does your organization determine the relative significance of climate-related risks in relation to other risks, non-climate related risks? What are your processes for assessing the potential size and scope of identified climate-related risks? What are definitions of common risk terminology used or references to existing risk classification frameworks that your organization might already use? What is your process for prioritizing climate-related risks, including how materiality determinations are made within your organization? So when considering this section, reflect on how your organization currently identifies non-climate risks through maybe third line or second line activities, such as risk management, internal audit function, risk appetite statements. A strong starting point for these disclosures is to evaluate where your organization's existing risk management framework and explore how climate-related risks and opportunities can be integrated into your already established processes. All right, last but not least, the fourth component of metrics and targets. So based on, CARB's minimum reporting checklist, that covered entity will need to disclose the metrics and targets used to assess and manage relevant climate-related risks and opportunities to reduce and adapt to climate-related risks where such information is material. So things to consider when drafting this section, were climate-related issues material? Consider describing whether and how related performance metrics are incorporated into your existing policy. Where relevant, provide internal carbon prices as well as climate-related opportunity metrics are an example of a type of metrics you could disclose. Other items to consider would include metrics should be provided for historical periods to allow for trend analysis. When you're describing targets, think about, is it an absolute target? Is it an intensity-based target? What is the time frame? What is the base year for which progress is measured? And then provide a description of the methodologies used to calculate targets and measures where it's not obvious to an independent reviewer. So this area, or this fourth component, represents a gap, for many organizations, as they may currently lack formalized metrics, targets, or KPIs that that they're currently doing because they haven't identified any material climate risk yet, but they have plans to, track these in alignment with the strategy, governance, and risk management disclosures that they're currently developing. So one thing to note, for organizations that are also complying with SB 253, this is where your Scope 1 and Scope 2 greenhouse gas emissions and eventually Scope 3 greenhouse gas emission will become an integral component of this section if they're not already included in this report. Other examples of metrics and targets could be energy consumption, renewable energy usage, emission reduction goals, and progress towards sustainability initiatives. So establishing clear and measurable metrics and targets is important for monitoring performance and providing transparent disclosures with the TCFD framework. And with that, I'll pass it over to Anna for our third polling question.
All right, let's do it. Now you've heard about 261. We want to hear, are you prepared to publish a climate financial related risk report in accordance with SB 261? So is the answer no? And thankfully you don't have to because you're not in scope. Maybe not yet, but you've got it in the works. Maybe no, and that's something that you should bump up a little higher on the to-do list. Or the overachievers, maybe you've already got that ready to be published. Maybe you've already linked it in the docket. So let us know kind of where you're at on that spectrum. And I just want to echo Maddie's points about it. Certainly there is a lot that can be included in these TCFD reports. And it's really a scale, and it's something that can grow as you become more experienced in reporting this type of information. So while it can be a little daunting for your first report, there may be a lot of gaps. It may be just being transparent about what you're currently doing and where there are gaps. And the expectation, I think, that CARB has been clear about is that these sort of grow and mature over time, and to not get too bogged down in all of the individual, very qualitative scenario analysis type things, and to really just have this report meet where your organization is right now and give a little insight into what that process is. So thank you for answering the poll. We'll move on. Okay, a mix of people in the works and people who are feeling happy that they maybe aren't subject to the 261 for this first year, which very fair. It's certainly a lot if this isn't something your organization has been previously reporting. Okay, now we are going to hit on some of the important recent updates that clarify and tweak a few of the things that we've talked about as the core elements of these regulations. So, at the beginning of this session, when I said it's been a year, it really has. We got the CARB enforcement notice in December 2024, just about a year ago. And we've had updates and new information and changed information every couple of months throughout 2025. So 3 workshops, May, August, and November, some critical information really coming out of those workshops, some FAQs and updated FAQs. Definitely recommend that you visit CARB's webpage for these regulations. That's where you can find the FAQs, the checklists, the various resources they've provided. At the end of this presentation, there are links to those websites, so that is available to you for easy access. Okay, so summarizing some key updates that came out of the November 18th workshop. So specifically for SB 253. A big update that came out was the revision of the proposed deadline. So in the August workshop, we got from CARB a proposed deadline of June 30th, 2026. Excuse me. And that was revised in the November workshop to August 10th, 2026. So CARB noted they got some feedback from stakeholders that June 30th deadline was going to be challenging, and it aligned with some financial reporting deadlines that organizations would be focused on. So a little bit of reprieve there. They did note this is just the deadline for the first year of reporting. So we will expect in 2026 to hear more about what kind of the ongoing reporting deadline will be for 253. CARB also gave some clarifications for entities that do not have calendar year ends and how to determine which year of data to report. So if you're an entity that has a fiscal year ending between January 1st and February 1st, 2026, then you would be reporting data from fiscal year ending 2026. If your fiscal year falls after the end of January, so if you're falling between February 2nd and December 31st, 2026, then you're reporting your fiscal year 25 information for this first reporting period. The thought from CARB here is that then regardless of what your fiscal year end is, you have at a minimum 6 months from your fiscal year end to the reporting deadline Some entities may have longer than 6 months, but at a minimum, you have at least 6 months before the reporting deadline from your fiscal year end. Now, two quite large updates that came from the November workshop. The first was that CARB came out and said that if you were not collecting data or were not planning to collect data at the time that the enforcement notice was issued, which was December 2024, then you are not expected to submit a Scope 1 and 2 reporting data for 2026. So if you were not previously calculating your greenhouse gas emissions or were not planning to start calculating your greenhouse gas emissions before December 2024, then you have a pass from CARB for this first year for reporting in 2026. CARB has the sentence below saying those entities would then just submit a statement on company letterhead to CARB indicating that they were not collecting this data prior to the enforcement notice and that they will not be submitting a report. When we receive the final rule in Q1, I expect a little bit more guidance from CARB in terms of the actual logistics of, exactly what needs to be in that statement and where you submit that, et cetera. But for now, generally expecting that those companies not previously calculating their greenhouse gas emissions essentially have an additional year. The other large update here was that CARB did say they will also not be requiring limited assurance for data submissions for 2026. So the Senate bill does require limited assurance, but CARB is essentially stating they won't be enforcing that element of the Senate bill for 2026. So if you will still be submitting your Scope 1 and 2 data by that August 10th deadline, no entities are required to receive limited assurance over that information to be in compliance with CARB. Now, as an ESG assurance professional, I would still say, I think there's value there in exploring obtaining limited assurance or some other sort of readiness for this first year, but not required by CARB for this first year. And then we also got some clarification from CARB that the draft Scope 1 and Scope 2 reporting template that they had put on their website is optional for companies. If your company is calculating your emissions and reporting that in a different format than that template, CARB will accept whatever form your greenhouse gas emissions footprint is in. Again, I think in Q1, really the most important information that's going to come out of that final ruling is the logistics information about what is the essential information in the footprint that needs to be disclosed to CARB and where will that be provided. And so don't have guidance at this time in terms of the actual logistics of getting that submitted. Okay, and then 261, I would say, got less attention on the CARB workshop, a little bit more time spent on 253. But for 261, they did reaffirm that there isn't a change to the reporting deadline of January 1st, 2026. They mentioned that they'll be opening the docket for submitting the links where you have published those climate financial related risks. That will be open from December 1st. It is currently open and will run through July 1st, 2026. They said they've kept it open to July 1st, 2026 as a matter of convenience for companies to give you time to post the link. They don't view the July 1st as a revised deadline, but rather just wanted to leave it open to give companies time to post that link at their leisure. And then primarily to what Maddie already covered, making sure you're disclosing the framework that you're using for your report, and then discussing which of the recommendations and disclosures you have included in your report and which you weren't able to, and kind of any plans you have for making improvements in the future. Some other not specific to a regulation guidance from CARB. They did, again, note that their list of in-scope entities has several issues, and so that should not be relied on as a compliance tool. Just because you are not included in that list does not mean that you may not be subject to this required reporting. They included some flowcharts helping to clarify parent-subsidiary relationships. So if that's something that's applicable to your organization, taking a look at those flowcharts to make sure you're properly identifying your in-scope entities. And then included a snapshot of kind of 2026. So we've got our January 1st reporting deadline for 261. In Q1, we're expecting CARB to present their proposed final ruling to the board and then receive board approval. We generally are not expecting significant changes from what was communicated at the November workshop. And so that's generally our recommendation in the face of having to, submit these reports before the final rule, is to follow the guidance from the most recent workshop. August 10th is the 253 deadline. And then September 10th is what they've put as the proposed date for fee assessment for filing these two regulations.
We're going to jump to our fourth polling question.
Let's do it. Should we get our CPE?
Yeah, you got this, Anna?
Yes,
yep.
Absolutely. All right. So I know we've given you a lot of information and we're rushing at the end here, but how are you feeling in general about the recent updates with 253? Are you feeling like, what is this happening to you? It's hard to keep up with these changes. Do you generally feel like you've been able to take it one step at a time and you're moving towards compliance? Or is this really just another day in the life of your role having to keep up with changing regulations? So please make sure you get those polling questions in. And, we've alluded to the 261, so maybe we'll just talk a little bit about the update there. So on November 18th, essentially at the same time that the CARB workshop was happening, the announcement came out that the courts had temporarily stayed enforcement of 261. Let me close. Everyone get your last CPE answers in. So this is not for that you get your credit. Give you one more second. Okay. All right. Yep. Just another day in the life, one step at a time. This is a good group. People are feeling cautiously optimistic. So let me go back here to, where did we, we jumped us way ahead. Here we go. Okay, so I think the critical element we can kind of close out on here is just kind of our thoughts in terms of 261 being paused, because I do think this is confusing to a lot of people. So because of the ruling for the injunction, CARB's enforcement of 261 is currently paused. And so while the reporting deadline is January 1st, that will not be enforced until after resolution from these oral arguments. The oral arguments are scheduled to occur on January 9th. So it's not buying entities very much time out from that January 1st. Our recommendation is really that companies continue to prepare for being ready to publish their report shortly after the oral arguments are resolved. This has been brought to the lower courts. The lower courts did generally uphold 261. And so in most cases, the Ninth Circuit is upholding the lower court's decisions. And so we do think there's a pretty good chance that this will go back into being applicable for organizations. And so I think continuing to prepare, but you do currently have a reprieve from CARB enforcement until after this injunction is lifted or that there's formal resolution there. Anything to add there, Maddie, that you want to chime in on?
I think I'll talk about it in a couple of slides, but yeah, as of now, the January 1 due date is not enforceable by CARB given the injunction, but almost everyone that we're working with is still moving forward to that January 1 due date, expecting that it will be lifted and back to being enforceable. So obviously we're very interested to see how that January 9th court case turns out, but at this time it's not really changing the trajectory of what our clients are doing. They're continuing to draft the reports knowing that eventually, it will be enforceable again at this time.
Perfect. And maybe you just want to close out with some thoughts on preparing for 2026.
Yeah. All right. So preparing for SB 253, although CARB has provided some concessions for 2026 reporting requirements, we do recommend, you continue moving forward with calculating your Scope 1 and Scope 2 emissions now. Starting early will really help you avoid last-minute issues and support your data as accurate and complete. If you do prefer not to pursue limited assurance for your 2026 submission, we do encourage, potentially doing a greenhouse gas readiness assessment. This assessment will help you identify any critical gaps or missing data in your calculation process so you can address them proactively before, formal reporting is required. Obviously, we're all staying tuned to CARB's final rules in Q1 of 2026. We're going to be very interested to see how the court cases turn out for SB 261, but it's really important, continue joining these webinars, continue, getting educated on what CARB is putting out there. It does seem like it changes every other week, so we'll monitor this closely, but make sure that you're also staying on top of the resources that CARB is providing that is available to the public. Common errors identified in greenhouse gas emission calculations. I would just note, if you're preparing for SB 253 and you're feeling a little unsure about what this is where the greenhouse gas readiness assessment really does come in handy because it, reviews your calculation, gets you ready for assurance. But some common errors that we do see starting with clerical errors. So it's really simple mistakes in data entry, which can lead to incorrect numbers. So even if you're using a software, please make sure your data entry is correct in those data gathering templates. Double check your activity consumption amounts and your unit of measurement is correct. Missing locations is another one where sometimes a facility or operational site gets inadvertently left out of the inventory. So double check that those facilities are included. Outdated emission factors, make sure you're using the most updated emission factors. So there's a lot of little errors here that with just another review can catch these prior to, seeking that assurance opinion. And then kind of echoing, what we've been talking about for SB 261, even though there's that court injunction delaying enforcement of SB 261, we do recommend you continue preparing those reports, expecting that this, dismissal will get lifted. And then, just make sure you're looking at CARB's reporting checklist. You're looking at those minimum reporting requirements. Don't be scared by all the slides I showed earlier. The minimum reporting checklist is really straightforward, and it does, give you that reprieve of just identify your current state, identify your gaps and plans in the future to address those recommended disclosures. And with that, I'll pass it over to Anna.
Perfect. Just wanted to note there are other states that are starting to move forward with similar regulations. California sort of expected that they would get the party started and that other states would follow along. The hope is that other states are adopting regulations that are really very similar to California so that we aren't creating sort of multiple different reporting requirements state to state, but that it's really sort of one requirement that's getting adopted by several states. We do see good alignment on the Illinois, New Jersey, New York regulations that are currently going through the legislative process. Outside of just greenhouse gas emissions and climate financial risk related regulations, there are also regulations popping up in the United States related to specifically fashion producers and some regulations on reporting in that space as well. We'll close out with just a note about how Baker Tilly interacts in this space. So we assist clients with preparations for the regulations, whether that be performing greenhouse gas emissions calculations, helping scope applicability of the regulations, developing things like the 261 TCFD reports for clients. We perform ESG assurance review. We work both with US-based and international companies, but really just here to be a resource, answer questions. Maddie and I get on lots of calls just talking through, what are recent updates? What does this mean for your company? So now you've met us both, please don't be shy to reach out and set up a call or talk about this a little bit further if you have questions. With that, I know we're just at time, so I'll turn it over.
All right. Thank you, Madison and Anna, for a great presentation today. If we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Please also visit mossadams.com for future webcasts and other resources to help elevate your performance. Thank you for joining us, and we hope you'll join us again next time.